How did the average investor in Peter Lynch's legendary Fidelity Magellan Fund, which averaged 29% annual returns, actually lose money? It wasn't the fund itself, it was the behavior. Chasing highs and selling low, even the smartest people sabotage their own results. This is the behavior threshold, recognizing when your own emotions are your biggest portfolio risk. Welcome to part 3 of our Beyond DIY series. The behavior threshold is the point where you recognize that human nature, our innate tendencies towards fear, greed, and chasing performance can sabotage even the best laid financial plans. It's acknowledging that disciplined, objective guidance isn't a sign of weakness, but a strategic tool to defer costly emotional mistakes. We all think we'll be rational when the market gets chaotic. History and data, however, tell a different story. Even the brightest investors can fall prey to behavioral biases. Let me share one of the most famous and frankly startling examples of this. Peter Lynch's Fidelity Magellan Fund, which he managed from 1977 to 1990. Over that time period, Lynch delivered an incredible 29% average annual return. He was arguably one of the greatest fund managers ever. And you'd assume that anyone invested in this fund became extraordinarily wealthy, right? Wrong. Shockingly, Fidelity's own internal study revealed that the average investor in the Magellan Fund actually lost money during that exact same period. How is that even possible? Well, it's a classic illustration of the behavior gap. Here's what happened. Investors, understandably excited by the stellar returns, would pile into the fund after a period of strong performance, buying at an all-time high. Then, when the market inevitably hit a rough patch or corrected, those same investors would panic and sell at a low point. They were chasing past performance instead of sticking to a disciplined strategy. They let emotions drive their decisions, doing the exact opposite of what you should do, and ultimately destroying wealth in the process. This is where the behavior aspect of financial advice becomes invaluable. It's about having a trusted partner whose job it is to help you build a sound plan and critically stick to it, especially when your emotions are screaming at you to do otherwise. And again, the advisor's structure matters immensely here. Is your advisor incentivized to provide steady, objective guidance aligned with your long-term success? That's the fiduciary model. Or could their compensation be tied to transactions? A non-fiduciary might, consciously or unconsciously, encourage you to make a move, even if it's emotionally driven and detrimental, because trading activity is a component of how they get paid. True coaching requires unwavering alignment with your best interests, especially during turbulent times. Recognizing the behavior threshold is about understanding that successful investing is as much about managing behavior as it is about managing assets. Even the smartest DIY investors benefit from an objective sounding board and disciplined framework to navigate market volatility and moderate emotional pitfalls like performance chasing. Have you ever bought an asset at a high after seeing great returns, only to sell low during a downturn? Have you found yourself constantly tweaking your strategy based on headlines or fear? If so, you might benefit significantly from an objective guidance that comes from working with a fiduciary advisor. Click the link below to schedule a brief introductory call. Let's talk about building a disciplined strategy designed to weather market cycles. Make sure to subscribe. In our final video, we'll discuss the continuity threshold, ensuring your financial plan has the structure to protect your family and your legacy across multiple generations. I look forward to seeing you then.